The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady. You got 29 days till the end of 2023, and we're going to give you some last-minute tips and things that you might know that are tax-free and things to help you to make sure that you get the largest refund and pay the lowest taxes. And I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey, happy Saturday.
Happy Saturday. And Christopher Fabian.
Hello, Esther.
Hello, Christopher. So, you know what I'm doing after the show?
You're
Christmas
going to make
shopping.
raviolis.
I'm going to make raviolis. Yeah. So this is our family tradition, and well, I'm going over to my niece's house, and she has a 4x8 sheet of plywood, and we make like 500 raviolis. So my brother and my niece and everybody's going to be there, and so it ought to be fun.
Yeah.
Looking forward to that.
We went to dinner a week ago with a couple, and I was talking about how I like Italian wedding soup, and they said that they made all those little meatballs by hand one time, and they're like, never again, because their fingers hurt because of those little tiny.
That's true. Cooking is, I mean, when you think about cooking the old-fashioned way,
Yeah.
I mean, wow. You know, no wonder why ladies were in the kitchen so much.
Yeah.
Anyway, I'm Esther Gulius, the Tax Lady from EG Tax, 8030930. 8030930, star 930 on the cell phone. You can text us at 716-8030930. And so I also wanted to tell people that don't forget, interest rates are very high. And if you have some money in a low-bearing interest account, you really are not taking advantage of what you can get. So Synchrony Bank is the one that's paying the highest rate right now, 5.65% on a 14-month CD. And if you want to tie it up for 5 years, Barclays Bank will do it for 5 years at 4.50. So you think about that. That's a lot of money that you would get extra. So all you have to do is go to your bank. These are FDIC insured. And the least you ought to do is do that. And actually, money market accounts, you can go to KeyBank and get 5% on a money market, on a CD at KeyBank as well. And money market accounts, which don't tie it up at all with any specific term, are between 4 and 5. So
Yeah, we might actually see a lot more 1099 INTs this year.
right, I'm sure we will. Right?
Yep.
But speaking of changes, remember we've been telling you about the 1099K form, third-party pay over $600. You're going to be getting a 1099K, and how difficult it's going to be, and a lot of them are going to be wrong. You got to include the income. Well, they changed their mind.
Yeah.
So last week they altered the rules for the 1099K, and this year they're just doing the old rules, so you won't be getting a 1099K form unless your third-party pays are over $20,000.
Yep.
So that's a big deal.
change.
you know.
Yep, that's right.
Big change.
And then-
Next year, I know it's like crying wolf because they keep saying they're going to do this. Next year, it's for third-party pays $5,000 or more, and then they're going to phase it in to the $600 or more the year after that. So if you were somebody that was worried about what to do with the 1099K, you're good to go.
Yep, your worries can be set aside.
And it's not to say that you won't get one, but the laws are you're not supposed to.
That's a great point, Chris, because if you're dealing with somebody that says, well, no, we're ready to roll these out, and they give you a 1099K form, we know what to do with them. So don't ignore it, because that means the IRS has gotten a copy of that, and you want to make sure that you put it on your tax return if you got third-party pays. Let's go over that, though. What's an example of a third-party pay?
Venmo and
PayPal
and
Cash App.
Zelle.
Not Zelle.
Oh,
Zelle
not
is a
Zelle's-
bank-to-bank
That's right.
transfer.
Zelle's bank to
Right.
bank.
Yeah.
Right. So if I'm wiring money to my kid in college in Albany, and I sent them $12,000, it would have been that my child would have gotten a $12,000 1099-K form, but not now,
Right.
right?
Which makes
So-
it, they're
And but that
phasing
makes
it
you
in.
that should make you rethink about would you even want to use a third party pay when you can use Zelle, because as long as it's bank to bank, you're never gonna have to worry about it.
Right, right. And, I read an article, saying how, people are so glad they did this. But you know what? Even when you sell sporting good tickets or concert tickets and you make money, that's still a reportable transaction.
exactly right.
And you
That's
have to
exactly
report that. So
Right.
it's
Okay, so we have like 29 days till the end of the year, and whatever is effectually income or a deduction as a qualified deduction or dependent or filing status, that all closes December 31st at the stroke of midnight. So I was talking to a young man the other day about filing status, and I said, so if on December 31st at 11 o'clock you were married, but you got a divorce at 11:30 on December 31st, as of the end of the year, you would have been single, right?
right.
Yep.
So it's what you are as a stroke of midnight as of 12/31, and that includes income and everything as well.
Yeah, there was somebody who called the office the other day, and he's like, I know I waited a long time, but I got married in 2023, so should I go and change my withholding form? And I said he could, but there's no problem that he didn't. He thought he really was going to have a problem, but you can't.
You could have a problem, but the thing is, at this point in time, if there is a way of getting rid of or eliminating the penalty if you paid in at least as much as last year's liability. Even though you owe money this year, they won't penalize you. And you use a Form 2210 for that,
Yep.
right?
Correct.
Okay, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Okay, so if I'm 73 and I have money in a pension plan or IRA, what do I have to do this year?
You have to take your RMD.
Which is required minimum distribution,
Yep.
right?
Yep.
And a lot of people think that if I have $100,000 in my IRA and I have to start taking my required minimum distribution, that it's a lot of money, but it really is a lot less than you might think, right?
Yeah, yeah. Depending on your age, that determines the divisory rate. But on 100,000, we'll say for somebody who's 73.
That would be $36.36 they'd have to
Yep,
take out.
roughly.
So
Yep.
$3,636. So, and then it grows each year as you move away from 73. The
Yep,
amount,
the divisory.
the divisor, right? So those RMDs, if you're 73, you have to take it out before December 31st or April 1st, right?
That's right. You have that option.
If it's your year you turn 73, yes.
Right. If the year you turn 73, you can take it out up till December 31st, or you can take advantage of that first time requirement, and they actually let you take it out without a penalty up till April the 1st.
That's right. So you just want to weigh it out and see which way. Maybe for the year of 2023, you had lots of earnings, lots of stock sales. So maybe you want to defer it. Now, maybe you didn't have lots of income in 23, and maybe you'd want to take your RMD in 23. And so you
And
really
if
have
you
to weigh
don't
it
know
out.
what to do, give us a call, because many people can take out a lot more than their required minimum distribution and not pay any taxes at all. So just because they say your requirement is to take out $3,600, based upon your tax situation, you might want to take $20,000 out because it's going to be tax-free.
Right. And you may not want to wait till you're 73 because that
That's
could have been
right.
your same situation at age 67. So
Right.
you could have taken the money out tax-free, brought
Because
that balance down.
The standard deduction this year for married couple filing jointly is $30,500. So think of all that tax-free money that you can take out of your RMD and just put it into another investment. So you've already paid the taxes, and it won't be sitting there for your heirs to pay taxes or yourself. Right?
Right.
Okay. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break, and we'll be back on the other side.
We are family. I got all my sisters with me.
Hey, all my family that's listening, we want to help you. I'm Esther Golias, the tax lady from EG Tax, joined in studio with Christopher Fabian, Tiffany Fabian. They're my right-hand guys. When you are looking at RMDs, what's one way that somebody can get rid of the taxable portion of the required minimum distribution altogether?
They could do a qualified charity rollover.
Right.
A
So
QCD.
It goes directly from their
It's
qualified
gotta be an IRA.
and goes directly to a charity.
Right. And so that way, if you did that and you took your $3,600 out and you did a qualified charitable rollover, it's going to be not taxable at all. And so a lot of times people are making monthly contributions or ties to their church. I suggest just do it once a year using your QCD, and you save all the taxes on that.
Yeah, that's right. That's right. And it's nice. It makes less of your Social Security taxable. And if you worry about IRMA, which is the extra Medicare tax, that will help to shrink that as well.
Right. Let's talk about Irma. She's a nice lady, right? So
She makes the sauce for your raviolis.
So when you're rolling right along, you're on Medicare, and everything's great, and then you sell a bunch of stock, let's say $150,000 gain on stock. What does that do with your Medicare potentially?
Oh my gosh, that raises your Medicare from, we'll keep it simple, the usual 170, and it could bring it up, depending how much you said, about 150,000. So that could mean about an extra $150 a month for your Medicare. And if you're married, that means 150 extra for you and 150 extra for your spouse. So
Now,
that's
how long do they keep that? And because I've been dealing with this with a client of mine all week, how long do they keep the increase in the Medicare active?
1 year.
1 year?
1 year.
Okay.
And
So
then
the
they
next
look at
year,
your...
if your income drops back down, so will your Medicare contribution.
Correct.
Okay, do you have to call them and tell them?
Nope, it's automatic when you file your return.
Okay,
That's how they get your income.
all right. So that's, now what if you don't have to file the next year?
Oh, I would file just to
Make sure that they got it.
Yep.
Right. So those of you that have this income stream that you weren't aware of, it's a surprise. It's only a problem for the 1 year.
Right. And
unless
if
your
it's
income stays high.
if it's a one-time event, you retired and you got a buyout, and then you started your retirement, and it brought you over the threshold, you can then request an abatement to that increase. But if it's something voluntarily, like you sold the stock, like you said, they're probably going to say, no, we're not going to do it for you.
Okay, and then let's also talk about, we got 29 days to get rid of the income in our cafeteria plan. What does that mean, and why should we care?
Well, I hope you're hungry.
I didn't say pizza. I said
Cafeteria.
cafeteria plan, which is what? What does that mean?
That's your tax sheltered accounts you put money in, like a flexible spending account for childcare, a flexible spending account for Medicare, for medical reasons. They have them for other different things. And most FSAs are, if you don't use them, you lose them. And so you put 3,000 in, you use 2,000, you lose that other 1,000.
Right. So you want to make sure that because when do you set up your flexible spending account?
Usually
Beginning
like,
of the year,
yeah,
right?
December, you have to sign up for the
Right.
following
So
year.
that's something, there's two things you want to do if you have a flexible spending account or cafeteria plan. You want to make sure you spend any extra money that's in there that you haven't used, number one. And number two, you have to sign up in December, early January
During
for
open
next
enrollment.
year, where
Yep.
you kind of take a shot at how much you think you're going to need. It's going to be tax-free, right?
Correct.
And you also don't pay FICA on it.
That's right.
So if you have a cafeteria plan, flexible spending account, and you haven't used that money, you have 29 days to utilize it, or else you lose it. And you want to make sure that you talk to your employer about next year.
Yep. Should we go to Mark?
I guess so. Is Mark on the phone?
Yep. Hey, Mark.
All right. Hey, Mark, how can we help you?
Hi, folks. I'm a first-time caller.
Thank you.
I'm in my 60s. Actually, I'm a client too, but lately. But I have a question on backdoor Roth contributions from a traditional, and I wondered how you would work that and what are the limits to do that, to convert your money from traditional money to Roth to, from traditional to Roth.
Right. So you already have an existing IRA.
Yeah.
So a backdoor you wouldn't be able to do.
Okay, when can you then?
It would be where you don't have an existing IRA, you're still working, but you made too much money to put it in a Roth, so you're over $200,000. So then you put it in you open up a traditional IRA, it's not deductible, and then you convert it right away to a Roth. So you're still paying tax on the money, but you're using the back door to put it in the Roth because you couldn't use the front door.
What's the limit on the amount can go back door per year?
Well, depending on your age, at your age, it would be $7,000.
Oh, gotcha. That's the limit.
Yeah, what you would do now.
But you could still, if you wanted to do a rollover from your traditional IRA to a Roth, you can do that, but you have to understand you're going to pay the taxes on it right now.
Yeah, that's what I've been doing. I didn't know what the limit was in the amount. I can go from traditional.
Well, if it's in a traditional and you want to put it into a Roth, there is no limit.
Oh, okay. You just pay tax.
Yep.
You and that hurts a lot. Yeah.
That would hurt a lot. Yeah, it changed my tax bracket probably if I did enough. All right.
Right. And of course, you're on Social Security?
Yes, I am now.
And that would hurt your Medicare, too.
Oh.
Potentially.
See, that's what I didn't know.
Potentially.
Right.
Yeah. Oh, yeah. Well, it wouldn't be.
I mean, you really have to take into consideration everything
Well,
before
no,
you
what
make that move.
what Esther was saying, it could affect your IRMA, your
Right, the
cost
IRMA
of
and
your
your
Medicare,
Medicare,
depending how much you convert.
Yeah, they're not going to take away your Medicare, but you're going to pay more for your health insurance, potentially.
Yeah, which I try to avoid.
Yeah.
All right.
All right. Hey, thanks for calling.
Merry
Christmas.
Christmas.
Merry Christmas. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. You can text us at 716-8030930. So,
And we got a couple texts.
Okay, but let me just say this before we move on from our cafeteria plan. This is especially important, the cafeteria plan, if you have daycare, because that's a little more punitive, isn't it, that you have put into your cafeteria plan?
Right, because if you don't use it, you
added.
lose it, and then the money you don't use counts as
tax
income.
Added to your
Right.
income.
Yep.
Okay, all right.
The first text says, Esther, you mentioned RMDs at 73. I'm 75. I haven't taken an RMD yet. What should I do?
Okay, well then you have to basically pay a penalty, and the old penalty was 50% of what you didn't take out. The new penalty is now 25% of what you didn't take out. So, but if you have a good reason why, many times they will let the penalty go.
Right. And I mean, and let's see, it's 2023. So 2020, there was no RMDs. 2021, they started them again. So for 2 years, but like Esther said, if you have a good reason, you were sick, you were in a hospital, you submitted the paperwork to your broker and they didn't do it, and you have proof you submitted it, you probably get the penalty waived. So definitely give us a call.
And
we'll
what
see.
form do you use for that
5329.
that avoidance of penalty?
5329
Right.
on page 2, I believe.
Yep.
But usually there's reasons to get away from it. And the 50% penalty was alive and well for a long, long time. And so I was surprised when they dropped it
Right,
to
so the
25.
25% penalty, which they'll also reduce this year, is started brand new in 2023.
Yep.
Correct. Yep.
All right.
And the next text said, "Hi, is this real? 1099K. IRS changed the minimum to $5,000."
Well, actually, it's
We talked-
5,000 in 2024.
Right.
In 2023, it's 20.
Yep.
20,000. Not $20, 20,000.
Yeah, so 20,000 2023, 5,000 2024, and then they'll
And then all they said was that they're going to phase it in. So I don't even know what it'll be in 25 and 26, you know?
right, and who knows? They may next year say it's going to be 20,000 again, you know,
Right.
just like they did last week.
That's right, just like they did last week. But if you listen to the IRS's, you know, I just called the IRS yesterday, and they're still talking about the 1099-K form as if that's still the way it's supposed to be. So I don't think they've gotten up to the place where it isn't really going to be that prevalent this year.
Yeah, and I know they already changed their forms for it to be the $600. So,
Right.
you know, it's
Okay, let's go. Is Kevin from
Yep.
Pendleton? Hi, Kev. How can we help you, sir?
Hey, Feliz Navidad, folks. How you doing?
Feliz Navidad to you too.
Hey, just to make sure it's called the three banks, Synchrony, Barclays, and M&T. But
Okay,
my
so
question,
Synchrony Bank is an online bank paying 5.65% for 14 months. Barclays Bank is another online bank, 5-year CDs 4.50. Key Bank has I think 13-month CD at 5%. And several of the other banks are doing money market accounts that are still fairly high.
okay, but I mean, you sure we won't get taxed on that when we? You know,
Oh no, you'll get taxed on it.
The
You're gonna
interest you
taxed.
get
the
taxed.
interest you're going to get taxed on. But you
Oh,
got to
you
look
would,
at it this
okay.
way, Kevin. Let's say you keep $10,000 in your mattress, right? You're not going to pay any taxes because there's no money being generated. But if you got 5% on the 10,000, then you get $500 in interest, right? And so you might have to pay $100 in taxes, but you came out $400 ahead rather than putting it in your mattress.
Yeah, that really makes sense. Yeah, that's true. Okay, no, that is the taxes. Is that federal or is that what about
That's federal and
New
state.
York and state?
Now,
Okay.
if you got treasury bonds, treasuries are paying fairly high. Those are tax-free on New York State. And if you got municipal bonds, those are completely tax-free, federal and state, but the yield is way low.
Oh, okay. Okay. Okay, great. Hey, see why I'm a much brighter person when I listen to folks like you.
Thanks,
all?
Kevin.
All right. Take care.
Feliz Navidad to you.
Right back at you.
Felicitations, dude.
All right.
Take care.
All right, we got to take a short break for news. 8030930, 8030930, star 930 on a cell phone. Text 716-8030930. We'll see you on the other side.
We are family. I got all my sisters.
Hey, to us, you are family, and we just want to tell you that our offices are going to open up right around the 15th of January, right, Chris?
correct. Yep.
And the IRS is going to open up like the 22nd, something like that?
Yeah, if they don't push it back, but yeah, right
so
around
what
there.
we'll do is we have all of our software. We're ready to go. We will take your return. It'll be the first one to go to the IRS, and actually we kind of sneak them in a little earlier. But basically, our branch offices will open on the 15th of January, and the IRS around the 22nd. And if you need any help, you can go to our website at egtax.com. And then we got a text, right?
Yep. It says there's two texts now. The first one says, "Can you tell us which states are similar to New York State for income tax in retirement when there is a New York State pension and Social Security, both of which are not taxed for my wife?" That's
No,
it.
for New York State.
All right,
tax.
so states that don't tax your pension income: Alaska, Florida, Iowa, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming, New Hampshire, Alabama, Illinois, Hawaii, Mississippi, and Pennsylvania. and specifically Texas, Tennessee, Florida just don't tax anybody's income tax. They have no state taxes.
Did you watch?
And-
Did you watch the debate the other day between DeSantis? No.
No, it makes me all too upset. I just,
Yeah.
Sorry.
But you,
don't do it.
I mean, that is a very good text question because we do have a lot of people who are moving out of New York State.
Yep.
And if you move to the wrong state, like
you'd be very sad.
I have somebody who both retired teachers moved to Connecticut to be by their daughter, and boy, they're paying a lot of taxes to
That's right.
Connecticut.
Right.
You
So
know?
you notice that Ohio's not on that list. So if you move to Ohio or Michigan, right, you're going to pay taxes
That's
Yep.
right.
on your pension.
Right, yep. And so then the other text said, my wife and I both receive Medicare. She's retired and I'm still working. I had one large withdrawal from my SCP, 120,000 K last year, and my wife and I both got IRMA. Letter saying our Medicare contribution would be about $350 a month each. Can I put the money into an FSA to pay for it?
He's still working to pay for
To
it.
pay for the Medicare?
Well, that's going to come out of your Social Security distribution. They just take it out of the money that they give you every month. So
Right. So
so if you did an FSA, you're not paying them directly. But I think you can. I think that in many situations where people are 65 and they have Medicare Part A and B and they aren't collecting Social Security, they can pay that directly.
yeah, but he should also. I hope that he's tried this already. Appeal it since it was a one-time large withdrawal. So he should try to appeal.
Well, just give us a call because we'll help you with the
Appeal.
with the letter, right?
Yeah, and you because what is the date, the deadline for?
You have 60 days.
Yeah.
So
you should give us a call so we could try to appeal it since it was a one-time large withdrawal.
Right.
hopefully, yes, that it's
Right. Okay, so I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. But the bottom line is if you're taking large distributions, you really have to plan in that extra tax that they're going to assess you because in his situation, it's $700 a month, right?
yeah,
So that's a lot of money.
yep. Oh, it's,
$8,400. Okay, let's see. Other things people should do is trust fund distributions. Now, why is that important?
well, because the tax rates of trusts, estates, anything using a form 1041, as soon as your income hits about 10,000, your tax rate is 37%.
That's huge.
Right.
That's a
So-
lot of bread.
So if you left in 10,000 in a fiduciary account that should have been distributed, the fiduciary is going to pay $3,700 in taxes. But had they distributed that 10,000 to you and you're in the 10% bracket, you would have paid how much? $1,000 in taxes,
Yep.
right? So you save $2,700 by doing the distribution. And these are things people, they set up these trust funds and they don't, or fiduciary accounts, and they don't even think about taking these distributions. And you need to take the distribution for it to flow over to your personal account, which will be in a much lower tax bracket. And in many cases, people don't have any taxes due at all.
Right? Yep. I
Right.
mean, so
So that's something that should be done before 12/31. Put money into your pension plan at work. You still have time.
Yep, you do.
Why would I want to do that? Why would I want?
It reduces the taxable income it reduces your income, so you're going to pay less tax. And the nice thing is you're putting money in your pension and you're saving tax dollars. It's a win-win.
I had a client the other day that emailed me, and she said they would like to set up a IRA for their grandbaby. Okay.
Right.
And I said, well, in order to do that, the grandbaby has to make money. And so they said, well, they're going to hire their grandchild. So if they're going to just hire the grandchild. And I said, well, that's not going to work because you have to show that it's a bona fide, legitimate thing in order to do that. So I said, why don't you put the money into a 529 plan? So at least you're going to get a deduction on New York State.
That's right.
Yep.
But now, if that baby worked for Fisher Price,
They could put
then they could put money into
as
an
long
IRA.
as they weren't covered by a qualified plan at Fisher Price.
No, this is for the baby.
A baby.
This is the
Okay.
baby.
Okay.
So the baby would be making the money, right?
Right. Right, as
So-
long as the baby didn't have a qualified plan.
Wait, but they were going to hire their own
That's what I
grandkid.
meant. Yeah. Yeah,
Okay.
that's bizarre.
Right. Anyway, but that, I thought it's very creative. They were really thinking outside the box.
Yeah. Oh, you want to go to Marie?
All right, let's go to Marie. Hi, Marie.
Hi, how are you?
Good.
Good.
What can
How
we
are
help
you
with?
doing?
Good. I'm calling about the Irma question.
Yeah.
Okay, I believe when you get one of those letters from Social Security, there are 7 reasons they will consider another year. And just because somebody took out, I think it was 110,000, there has that if they took it out to repair their home,
Right.
that's not one of the exceptions. It's usually death of a spouse,
A retirement.
stopping work, a retirement. I don't remember all these without having the letter in front of me. But, gee, if you had a great day at the races and you won a small fortune, that unfortunately goes into your modified adjusted gross, I believe, and you are going to be hit with Irma that year if you
Right.
go over those thresholds. So, as I say, there's 7 things in there that tell you when you can ask Social Security to use another year or the current year. And I think somebody should read that
Yeah,
letter a
it's
little better.
Death of a spouse, marriage,
Yeah.
divorce or annulment. You or your spouse
go.
stop. You or your spouse.
got 'em.
I got them. I'm trying to read them for people. You or your spouse stop being work to or reducing the number of hours you work. Involuntary loss of income-producing property due to a natural disaster, disease, fraud, or other circumstance, or loss of a pension. So,
Good
Okay,
point.
but that was very good of you to bring up that specific, those specifics. So, again, there are ways to wiggle out of the increase due to the extra income. If you had something like Chris was saying before, kind of involuntary bad thing happen to you, right? You should look at
One
that.
of those 7 reasons. And, or if you had sold some property and had a large windfall on it, that doesn't count unless maybe you were living in Florida and you had a major disaster, due to a hurricane. That would be a natural disaster. But
Right.
yeah, well, I know we had somebody who was very disabled, and he sold a rental property because it was his girlfriend that was taking care of the property, and she passed away, so there's nobody to take care of the property. And Social Security said, nope, you're still getting hit with your increase. So it's really up to
And
the
it
person.
is very
it's really
subjective.
sad.
Right. Very subjective. But thank you for your call, Marie.
okay, take care.
Thank you. All right. Other things you should do before the end of the year is if you are a small business, make sure you pay up all of your expenses that you have incurred if you want to reduce your overall tax liability. Because number one, it reduces your tax liability. If you're self-employed, it also reduces your self-employment tax. So that's something to do. The other thing is deferring income into the next year might be something you'd want to look at as well.
You want a funny story? Somebody today was telling me, and he had the video clip of it. This one executive of this big company, he realized how much chartering a jet is so stupid because he could just fly first class and it's so much cheaper. But he goes, but if I buy one, what a tax write-off I'll have. So he reached out to the airline company and said, I want to buy a jet. And they're like, no, well, we're 2 years out. You can't buy a jet. So he told his accountant, just mail them a check for $100 million. And so he called him up. He said, I just sent you a gift. Just, you know, and so they called him up and they said, we never had somebody prepay for a jet. And within 2 weeks, he got a jet. And so that was like December 28th. So he used the jet on one business trip. So it was used for business in that current year. So he was able to write it off.
Wow, who are you hanging around with?
All right, but let's do the rest of the story because this sounds like what other people think. But the thing is, he would have only saved like 40%.
Right, but it still saved him, and he needed a plane. So, but it
Right,
was
but
just
because assuming he's in the 40% tax bracket and the jet cost $100 million, he would have only saved like $400 million in taxes. But the rest of it, and if he sold it, he'd have to recapture it.
Who the heck are you hanging around this
I think
morning?
he should have just kept flying first class, but that's just me, right?
Right.
All right.
That's just you.
Yeah, we're going to take a short break. I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on the cell phone, 716-8030930 is our text number. We're going to take a short break. We'll be back on the other side.
We are family. I got all my sisters with me.
Hey, to us, you are family. I'm Esther Gilius, the tax lady from EG Tax with Christopher Fabian, Tiffany Fabian. We're trying to come up with things to help you to reduce your overall tax liability, make sure you don't overpay when it comes to your Medicare. We want to make sure that you're getting the highest interest rate off of your investments if you're somebody that's not in the market. And the other thing that people don't know is that a bunch of income is completely tax-free.
Yep, that's right, which is nice.
So the first one, and this could be a lot of money, would be personal award benefits on a lawsuit due to personal injury.
Yep.
So if you get injured and you sue for personal injury, that is completely tax-free.
You mean like when the lawyer's on TV? I got my client $5
$17
million
million
instead of $50,000.
That's right. But tax-free. Child support payments are tax-free.
Yep.
Disaster relief benefits. So if you're in a disaster area and the federal government comes in or state government comes in and gives you help, that's tax-free. Welfare benefits are tax-free.
Yep.
Employer-provided health benefits. People don't realize how much employers actually pay in health insurance for them, and that's a completely tax-free benefit.
Yeah, it really
It's
is.
on your W-2 form though. When you take a look at your W-2 form, you can see where the amount of money that was
code
spent
DD.
on your health insurance. Pardon me?
Code DD.
Yeah, code DD. All right, foster care payments. If you take in children as a foster parent, that's tax-free. Financial gifts. If you give a gift to somebody, people always say, how much can I give? You can get without filing a gift tax return. And that right now through December 31st is $17,000. Starting January 1st, it'll go to $18,000. So you can actually give anybody $17,000 this year without having to file a gift tax return, $18,000 next year. But if I wanted to give $40,000, will that be taxable to somebody?
No. Nope, it won't. You just have to do a gift tax return.
Right. And so when you do the gift tax return, it's kind of an accounting method for the IRS to make sure that you don't go over the
Lifetime exclusion.
accumulated exclusion upon your death, so that because they're waiting for you to die to get your death taxes. But this, if you are going to have an estate less than almost $14 million on the federal, you really don't have to worry about it. And you looked it up last week; it's like $6 million on the state, right, Chris?
Correct.
Yeah. Veterans benefits. That's another completely tax-free benefit.
Yep.
Inheritances, and this is another one, of money and capital assets. Now, money is easy to understand. So Uncle Charlie leaves $300,000 in his checking account. You get that. That's completely tax-free. If Uncle Charlie leaves you his personal home and you were not titled to it, why would that be tax-free?
Because you get the stepped up basis.
Right.
Yep. And so that is exactly
Now, if Uncle
why.
Charlie had your name on the house,
That's
Prior
not
to
bad.
death.
You get-
Prior
you-
to
you
death?
have to.
Then your basis is Uncle Charlie's,
Charlie's
basis,
right,
and
and you're going to pay taxes.
Yep.
Yep, it was a
So
gift.
very important if you're thinking about being generous this time of year to your kids, call us so that we can tell you a way to make sure that your kids don't end up paying the taxes on it. And usually that would be a life estate, right?
right for the sale of the house. Yep, for the house. Right.
Right.
And then
Now, and
you-
how about
wait,
stocks and bonds? Yes, sir.
I was going to say for inheritance, also you inherit mom or dad's IRA. That's
That's
tax.
a problem.
That's going to be taxable. So each thing you inherit could mean a different thing on your tax return.
Right. But plain old cash, stocks and bonds, capital assets, they would get a stepped up basis. But if it's anything like a pension, IRA, if it's their business income, pension income, that would be taxable, right?
Correct.
Unless it's a Roth.
Yeah,
Right.
because if it's a Roth, it's not taxable.
Right. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone, and our text number is 716-8030930. Interest on municipal bonds, I alluded to that before. It's just that
did.
if you invest in a municipality or like New York State Bridge Authority or anything like that, that's completely, if it's a New York State municipal bond, that's completely tax-free federal and New York State, but it has a much lower yield than, for instance, the money that they're giving you in the bank.
Yep, Kevin.
What
Kevin
happens
called
if
about
I
this.
have, my broker's got me invested in all kinds of bonds outside of New York State?
Well, tax-free on the federal, but taxable on New York State.
So you have to add it back in,
Correct.
right?
Yeah, and it gets really confusing, and so you really want to pay attention to that.
Well,
you know.
when they come in with with their brokerage statement at the end of the year, you have to flip through that and add in all the non-New York State municipal bond interest that somebody got because it's taxable to New York State.
Yes.
And believe me, if you don't, they will send you a bill,
Oh, they'll know.
right?
Yep.
It might take a year or two, but they will know, or two.
All right,
2
and
years.
then here's another one that people really don't seem to understand. The sale of your personal residence. How much is that? How much taxable is that?
It isn't unless you're a single person and your gain is more than $250, or if you're a married couple and your gain is more than $500,000. So there's a big exclusion there.
Right. But how long did you have to live in the house?
2 out of the last 5 years.
All right, so let's say I buy a house. I bought a house last July, and I get a transfer in January, and I have to sell my house, and I have $100,000 gain. Do I get to avail myself of that $250,000?
You'd have to percentage out the days out of the 2 years, and that percentage. So if that was 6 months, that's 25%. You're single at 250 times 25% is roughly 57,000.
$62,500.
There you go. So then 62,000 out of that 100,000 profit would be tax free.
Right. So you did that, but here's the key part to think about. Just because you could make 100,000, if there wasn't a critical need to sell the house, they'd make you wait the 2 years.
Correct.
In other words, in this case, he was transferred out. Maybe they found out that they have cancer and they had to go to another state for treatment. You have to have really a compelling reason to have sold that house before the 2
Yeah,
years
I mean,
if you want to do the allocation.
Like you sold it because they decided to build a development behind you. That's not a reason. They're
Right.
going to make you pay tax on all of it. So
Right.
just like Irma, there
that's
has
what
to be a good
I was
reason.
thinking
That's
about the
right,
same
good
thing.
reason. Again, Roth income, as long as you've
Over
kept it in for that 5-year period, right?
Yeah, you got to be over 59 and a half, and the initial deposit has to be at least 5 years ago.
Alimony on post 2019 divorces, that's all tax free on the federal. But how about on New York State?
taxable.
Yeah.
Right.
So it's different.
I don't care when you get a divorce, if you're a New York State resident, even though it's tax-free on the federal, you have to pay taxes in New York State. Housing allowances are tax-free. Rents for your personal home up to 2 weeks a year or less is completely tax-free. Property settlements because of a divorce are tax-free.
Yep.
Okay, and then here's some unusual things. Selling business equipment, that is, you recapture that as ordinary
unusual
income.
taxable stuff. Yep.
Right, and that's taxable.
Just like
but
that
you have to
airplane.
recapture it as ordinary income.
Just like that airplane that Chris was talking about.
Just like that airplane, right. Income earned abroad. I have people that write me that say that they are U.S. citizens living in Canada, and they have income from Canada. What do they have to think about?
They have to pay taxes on worldwide income, and
Which would be that Canadian income,
Yep,
maybe.
Yep, and then they're going to do an exclusion, a
Right.
foreign tax exclusion for paying taxes to another country.
Or there's also an income earned abroad exclusion,
Yeah,
correct?
That's right.
You know, I just was going back to the selling of your business equipment. You know, to think about this. How many people are working from home now?
A lot.
Right? And they're buying the desks, and if they're writing them off, even if it's just New York State, if they were to sell them in a garage sale 5 years later, that's going to be taxable in New York State.
Correct. That's correct. Yep.
You know, so you got, we joke about the airplane, but that could hit an average person.
Most definitely.
Right, and then illegal income, that's taxable.
It is.
A lot of people think, oh, no, it isn't. Oh, yes, it is. Illegal income is taxable.
You mean,
And under the table income is taxable.
What were you going to say, Chris?
I was going to say, you mean my bet with my bookie? I have to pay tax if I actually win?
You have a bookie?
I knew a couple.
Yeah, I do too. All right, and then income earned to another state if you're a New York resident. If you're a New York resident, you're working in Pennsylvania, you're going to pay taxes in Pennsylvania, and in New York State, you're going to pay taxes on that same income, but you'll get a credit for the taxes that you paid in Pennsylvania.
Yep, that's called a 112R, and it's commonly missed, but it's a good one.
And then another thing people have to watch out for, sales taxes that you haven't paid. So if you bought something and you didn't pay New York State the sales taxes, you have to report that on your New York State tax return.
Right. And, you know, I know we're running out of time. I just want to mention real fast to our listeners, don't forget, we do have our Toys for Tots bin at our corporate office on Colvin Boulevard. Drop off a new and unwrapped toy, and you can get a tax write-off.
That's right. if you have charity, right?
Yep.
Okay, I'm Esther Gillius, the tax lady from EG Tax. We just want to thank you for listening. If you need any
there's
help during the week, give us a call.
Really quickly, it says, "Hi, EG Tax. Love listening to your show. I'm not clear about the income Medicare dollar limit. Please explain once again for married filing joint. What is the dollar income threshold?"
We don't have time, but you can call us tomorrow, Monday at the office, 632-7886. Until next week, I'm Esther Gillius, the tax lady, Christopher Fabian, Tiffany Fabian. God bless you. Thanks for listening.